U.S. bond yields soar. Trump declares 35% tariff on Canada. And now, the markets are holding their breath. This isn't just a trade war. This is an attack on the global economic order. U.S. Treasury yields rose across the board on Friday, a direct response to President Donald Trump's announcement of a 35% tariff on goods from Canada, starting the 1st of August. This is the highest tariff ever imposed between the two allies in the post-war era. The 10-year bond rose 7 basis points to 4.417%. The 30-year bond rose to 4.955%. Even short-term bonds like the 2-year rose, indicating investors are pulling out of long-term bonds for fear of inflation. On Truth Social, Trump posted a letter to Canadian Prime Minister Mark Carney, accusing Canada of retaliation instead of cooperation. He also linked the tax issue to fentanyl. If Canada cooperates to stop fentanyl, the U.S. will reconsider. Trump revealed to NBC News that he wants to raise tariffs to all remaining countries to 15–20% higher than the current 10% that investors are used to. Trump has also previously imposed a 50% tariff on goods from Brazil, especially copper, a strategic resource for electric vehicles and renewable energy. This is a sign of a strategy to control global resources. Canada reacts immediately to retaliatory tariffs list. EU and G7 hold emergency meeting. Global markets adjust portfolios, fearing a full-blown trade war. Trump is no longer just tweeting. He acts with executive orders and threatening letters. The question is, can the U.S. economy withstand the global backlash? Or will the U.S. itself be the first victim in the war they launch? President Trump officially announced that the U.S. will impose a 35% tariff on all imports from Canada, starting the 1st of August, 2025. This is an unprecedented blow to the U.S.'s second-largest trading partner. Previously, Canadian Prime Minister Mark Carney had removed the digital services tax to calm the situation. The two sides even called and promised to reach an agreement before the 21st of July. But Trump suddenly changed course, sent a warning letter, and demanded to raise tariffs if Canada responded. Canada has responded by imposing quotas on steel and a 50% surcharge on excess quotas. Canada's finance minister says it is protecting our industry from unjustified U.S. tariffs. In the letter, Trump stressed that if Canada cooperates in stopping fentanyl, the U.S. may adjust tariffs. However, customs data shows that only 43 pounds of fentanyl were seized at the northern border, compared to more than 21,900 pounds at the southern border. Immediately after Trump's post, the U.S. financial markets reacted immediately. S&P 500 futures fell nearly 0.5%. Dow Jones lost more than 200 points at the opening session on Friday morning. More than 1,350 U.S. Street 8 Department employees have just been fired. Trump is doing something unprecedented, purging the entire diplomatic system in the midst of a global crisis. The timing of the firing comes amid Russia's continued war in Ukraine, escalating Israel-Iran tensions, and an ongoing Gaza conflict. But Trump has chosen this moment to restructure U.S. foreign policy. 1,107 administrative staff and 246 diplomats were terminated. Nearly 3,000 people left the State Department, including volunteers. Many had worked on human rights, war, and Afghan refugees. Senator Tim Kaine called it the most reckless decision amid China and Russia's rapid expansion of global influence. Meanwhile, dozens of staff shed tears, carried boxes of belongings, and left the headquarters, and were applauded by their colleagues. The layoffs coincided with the announcement of a 35% tax hike on Canada. Result: S&P 500 down 0.5%. Dow Jones lost more than 200 points. Investors worried about unilateral policies and macroeconomic instability. Secretary of State Marco Rubio, the man who implemented the plan, declared the current State Department bloated, bureaucratic, and no longer relevant in an era of power competition. He wants to hand power back to embassies, eliminating programs that do not serve core interests. The plan was blocked for months by a judicial order, but on the 9th of July, the Supreme Court gave the green light. Soon after, the White House and federal agencies sprang into action. Inside the headquarters, out-processing tables were set up with tissues and cardboard boxes. This is no longer about budget cuts. This is a message. America no longer puts diplomacy first. The question is, who will fill the void at the global negotiating table? Trump officially launches 35% tariff on Canada. Trade talks are torn up, and now it's a public show of intimidation between the two economic allies. In a letter posted on Truth Social, Trump said Canada retaliates instead of cooperates, and tied the new tariff to the fentanyl issue. He warned, if Canada retaliates, the U.S. will add any tariff to the 35% figure. This 35% tax is separate from other sectoral tariffs, such as 50% on steel, aluminum and copper, 25% on automobiles, and 10% on energy. Any goods that do not comply with USMCA will be directly hit. On the 29th of June, Canada withdrew the digital services tax to resume negotiations. The two sides committed to finalizing the agreement by the 21st of July. But on the 11th of July, Trump sent a letter threatening tariffs, breaking the spirit of negotiations. Canadian Prime Minister Mark Carney wrote, "We have made progress in stopping fentanyl and are committed to continuing to protect our communities." He affirmed that Canada will continue to protect domestic businesses and workers. Canada imposes 25% tariffs on U.S. cars that do not comply with USMCA, along with a list of U.S. goods subject to retaliation: steel, aluminum, computers, food, clothing. These measures will remain in place until the U.S. removes the steel-aluminum tariffs. Trump accuses Canada of maintaining tariff and non-tariff barriers, causing a trade deficit of $62 billion by 2024. He calls this a threat to U.S. national security. The U.S.-Canada trade relationship is no longer a dialogue. Every tweet, every executive order is now a blow to the supply chain and confidence in the North American alliance. Trump announces 35% tariffs on Canada, 50% on Brazil, and 15-20% on the rest of the world. Coffee, copper, cars, all are in the eye of the storm. This is no longer a tactic. This is global restructuring. Brazil is the world's #1 coffee exporter. The U.S. is the largest consumer. A 50% tariff has sent coffee prices skyrocketing, threatening every American latte. Bitcoin surpasses $116,000, new all-time high. Institutional money pours in thanks to Trump's crypto-friendly policies. An asset fever is rising. Nvidia surpasses $4 trillion. TSMC announces huge profits thanks to demand for AI chips. Despite the spreading trade war, investors still believe in technology. 10Y and 30Y yields edge up after stable bond auction. Fed still signals possible rate cut in July, despite White House pressure on Chairman Jerome Powell. EU increases coal and gas use, causing emissions to rise. Energy transition stalls. China holds stocks steady and begins to discuss cryptocurrency strategy. NY Fed and SF Fed release research showing a 10% chance of returning to 0% interest rates in the next 7 years. Meanwhile, Trump's offshore immigration policy is causing global controversy. From tariffs to cryptocurrencies, from AI to coffee, the world is being reshaped every day. And behind it all is a global domination strategy from the White House. Trump announces 35% tariff on Canada, threatens to punish EU, Japan, Korea, and the rest of the world if they do not sign a reciprocal agreement. A new trade war is starting, with letters. Since the beginning of the week, Trump has sent more than 20 trade warning letters to countries. Countries that do not receive the letters will be taxed 15%, 20%. Countries that receive the letters must sign a commitment to pay a 10% tax. Canada is facing a 25% tariff on cars, 50% on steel and aluminum, and from the 1st of August, it will be 35% on all other goods. Trump also threatened to increase it if Canada retaliates. Trump included fentanyl in a letter to Mark Carney, saying that if Canada cooperates in controlling fentanyl, the U.S. may adjust the tariff. While data shows Canada is not the main source, EU has 21 billion euros in retaliatory tariffs ready if Trump fails to sign the negotiating framework. Japan and South Korea could be next if no deal is reached. U.S. Court of Commerce has ruled that Trump exceeded his authority by imposing tariffs without an emergency. The appeal will take place on the 31st of July. If Trump loses, all tariffs could return to zero. USMCA replaced NAFTA in 2020. Now, the 2026 review process is frozen due to Trump's repeated cancellations and renegotiations. Canada and Mexico are trying to salvage the deal. U.S. trade policy has become a personalized political tool. When every country receives threatening letters, there are no more rules of the game, only orders. Trump sent markets into a tailspin with a letter announcing a 35% tariff on Canada. But hours later, the White House left the door open for some industries. The 35% tariff will apply to items currently subject to a 25% tariff, but key exemptions will remain. USMCA and energy goods such as oil and potash fertilizers will still be subject to low tariffs. Steel, aluminum, autos, and soon copper are already taxed at 25–50%, so they will not be subject to an additional 35%. This is a signal that Trump is going big on symbolism, but leaving a way out. Although the initial shock caused the market to drop slightly, thanks to the early exemption information, investor sentiment gradually stabilized in the Friday session. The tax date is the 1st of August. There is still time to negotiate. The European Union is waiting for a letter from Trump. Germany wants a quick deal to protect its exports, while France is tougher, opposing a one-sided deal. The EU is hesitating. Trump sends a threatening letter first, then leaves open negotiations through carve-out. The goal: to force each country to agree to its own tax agreement, turning the multilateral trade order into a controlled bilateral network. If Trump loses the lawsuit in federal court on the 31st of July, all new tariffs could be invalidated. This is a factor that could reverse the entire situation right before the activation date of the 1st of August. What Trump is doing is not just a negotiating strategy, but a model of controlling the global economy by decree, handwritten letters, and semi-public messages. One day, Wall Street hit a record high. The next, President Donald Trump ignited a firestorm. A sudden 35% tariff on Canada, and a looming 20% blanket tariff on the rest of America's trade partners. What followed? Markets tumbled. Investors panicked. And the U.S. may have just triggered a global trade war it can't afford to win. President Trump cited fentanyl as the reason for punishing Canada. If Canada helps stop the flow, we might adjust the tariff, he posted. But there's more to this letter than fentanyl. It's pressure, power, and a signal. In an NBC interview, Trump warned, all remaining countries will pay. 15%, 20%, we'll work that out now. This marks a dramatic escalation from the 10% standard investors had accepted as the new norm. Markets initially shrugged. On Thursday, the S&P 500 reached another record. The Nasdaq ticked up. Optimism still held. But by Friday, the Dow plunged 279 points. The S&P and Nasdaq followed, closing the week in the red. According to Barclays, investors are becoming desensitized to tariff shocks, but warned that growth and inflation impacts haven't yet hit the... This isn't just about Canada. Brazil is now facing a 50% tariff on copper. Vietnam blindsided by a sudden 20% hike. Canada's ETF dropped on the news, as its trade future with the U.S. was thrown into chaos. And yet, Trump remains unmoved. He says tariffs are well received and claims markets agree. Trump points to the S&P's strength. But markets aren't the economy. And bullish sentiment can turn on a dime. Barclays warns that punishment tariffs like the one on Brazil could shift sentiment overnight if they're not followed by rapid de-escalation. Wolf Research says the economy is entering a late cycle phase. There's a scarcity of secular growth, the firm warns. Only a handful of sectors, technology, and communications are growing revenues above 10%. That leaves investors paying premiums for fewer opportunities. Regional bank stocks have rallied. The KRE ETF jumped 8.5% this month. But Piper Sandler is sounding the alarm. Earnings season may expose cracks. With rising rates, weakening jobs data, and uncertainty ahead, this rally might be built on sand. Markets now await two things: a potential update on European Union tariffs and the official start of second quarter earnings season. Add to that key inflation data next week. Volatility may be low for now, but Piper Sandler warns, a storm is building. Is this the start of Trade War 2.0? Or is Trump bluffing using tariffs as leverage? Whatever the case, the global system is shifting. Investors, allies, and rivals are watching. And one thing is certain: markets may no longer fear tariffs. Until they should. Announcing today between U.S. Steel and Nippon Steel, he also just made an announcement of an expansion of the existing 25% tariffs that were imposed on steel. Donald Trump has told a rally at a U.S. steel plant in Pennsylvania, but he intends to double U.S. steel import tariffs to 50%, just double tariffs on all steel imports from 25 to 50% in just one night. Gas prices skyrocket, the U.S. industry is thrown into chaos, and Canada plays its $103 billion oil card. So who really holds the power in this trade game? Going to bring it from 25% to 50% the tariffs on steel into the United States of America. Donald Trump announced he was doubling import tariffs on steel and aluminum from 25 to 50%. This announcement came during a rally in Pennsylvania, where he praised the deal between U.S. Steel and Nippon Steel as proof that America was bringing manufacturing back home, shortly after Trump posted on social media, confirming that the new tariffs would also apply to aluminum effective June 4th. This move immediately shook the North American industrial world, especially in Canada, which exports about $35 billion USD worth of steel and aluminum to the U.S. every year. In Alberta and Ontario, steel plants were hit hard, with businesses not only losing market share, but also facing production cuts and job layoffs. The Canadian government called this a severe economic impact on their workforce and vowed not to stand by idly. The tax policy sends a clear political message: the U.S. wants to reshape the supply chain into a more closed system. But what Washington didn't foresee was that Ottawa's response wouldn't be as passive as it had been in the past. What Washington didn't anticipate was that this time, Ottawa's response would not be as mild as before. Oh, and before factories can adjust, U.S. consumers may soon feel the impact through skyrocketing prices on construction materials, cars, and consumer goods. As input costs rise, the final bills will land on the shoulders of ordinary households and workers. For the first time in years of restraint, Canada openly considered using its most strategic asset, oil. Specifically, Prime Minister Carney's government announced that it could reduce or redirect the $103 billion USD worth of oil it exports each year, equating to roughly $1.3 billion USD per day. This card, although never played, had always been kept in reserve as a contingency. And now, with the steel industry under pressure, this card has been officially laid on the table. This isn't just an emotional reaction. Canadian oil, especially heavy crude from Alberta, is a critical resource for many U.S. refineries. The relationship between the two countries isn't just about trade. It's an integration of technical and operational systems, designed and synchronized over decades. Once that flow is disrupted, rising fuel prices will spread to every gas station and small grocery store in rural America. Those who rely on pickup trucks and commute dozens of miles to work will be the first to feel the quiet ripple of this shock. Instead of retaliating with measures like counter tariffs, Canada is opting for a quieter but weightier move. They know that when it comes to energy, every economy must tread carefully. Amid the trade tensions over steel and aluminum tariffs, there's a quietly powerful factor at play: Canadian oil, and America's reliance on this supply. Every day, over 4 million barrels of Canadian oil flow into the U.S., fueling refineries across the Midwest and West Coast. Not only is it the sheer volume, but this heavy crude is perfectly suited to the technical design of U.S. refineries, which have been built around this specific type of oil for decades. If Canada were to tighten its oil supply even slightly, gas prices in the U.S. would spike immediately, and industries like chemicals, plastics, and petrochemicals would face severe raw material shortages. It's not that the world is short on oil, but finding an alternative that matches both quality and delivery speed is extremely challenging. Venezuela is under sanctions. The Middle East is too risky and distant, and domestic shale oil is too light to meet the needs of refineries designed for heavy crude. In other words, America can't quickly find a second Canada. The U.S. refining system was built on the assumption that Canadian oil would always be steady. If that assumption breaks, the whole operating model will face a structural shock, not just a temporary disruption. Ironically, the tariff policy designed to protect